Well, it's been nearly a year and a half since Royal Bank announced plans to acquire HSBC's Canadian operations. This week, the $13.5 billion deal officially reached the finish line with a countrywide integration to reopen HSBC branches and operations under the RBC banner. And for CEO Dave McKay, this sets the stage for some big growth opportunities. Of course, as the leader of the country's largest bank, he also thinks a lot about the outlook for the Canadian economy. We sat down with him for an extended interview, and he started by sharing some early takeaways on the HSBC integration.
I couldn't be prouder of RBC after the last 18 months as we worked tirelessly to bring this deal to a closure. The technology conversion that we've been able to accomplish over the last 4 days has never been done in Canada before, has never been done from what we can see in North America or maybe globally. Incredibly complex. Taking a bank from a global institution at HSBC, lifting it out in 48 hours, bringing it over and putting it on top of RBC technology stack, and every credit card, every debit card, every mortgage, every loan, every deposit, every corporate business has to work. And that's what we achieved over 4 days. So I'm incredibly proud of the organization and very excited about the future of HSBC and RBC together and what we're going to bring to Canada and clients.
Can you shed a little light on that? You know, for example, you've talked a lot about Vancouver as a possible hub for more growth. Maybe walk us through the thinking on that.
Yeah, certainly. You're referring to our commitment to open a global operations hub in Vancouver. It's a very important time zone for our global operations, particularly with a bank in California. That we plan to grow and prosper going forward. And therefore, as you think about your resources and where your talent is and where your skills, we need risk management skills, we need compliance skills, we need technology skills, we need operation skills. And when you have that in the HSBC employee base and you want to lever that, that gives us a great base to create a global operations hub with that, starting with that HSBC talent, then building it out with more talent going forward as we've committed to the community. So very part of our overall global operating plan, and very excited to put that into play over the next 5 years.
Now, on the road to getting to the finish line, there was a lot of conversation about RBC and HSBC coming together, the ultimate benefits for Canadians from that. What would be your perspective on that?
Yeah, thanks for asking that. We are so excited about the benefits to Canada, the benefits to clients, the benefits to RBC. And as you think about bringing these two great organizations together, first and foremost, we're expanding all those great trade finance, multi-currency accounts, that global connectivity that HSBC offered. We're going to make that available to all our clients, and all Canadians will be the preeminent kind of globally connected bank for Canadian business and consumers. So we've transacted that now, we've enabled that through our technology, and we'll make that available. That's going to help growth in Canada. That's going to help more exporters. That's going to really, I think, drive some GDP growth for Canada. Two, when we look at the success of bringing these two platforms together and the productivity that comes from that, it's going to end up us paying more dividends to Canadians. So right now, the dividends and the profitability of HSBC Canada were paid to global shareholders in the UK and in Asia. Those dividends are going to accrue now to Canadian pension holders and individual Canadian institutional and personal investors. That could be up to $700 million a year that used to go outside Canada is now coming and being invested through dividends to shareholders that reinvest in our economy or in markets. That's a productivity gain. That's significant. $700 million that used to leave the country is now staying in the country. We're going to pay more tax. That increased tax rate from that incremental profitability will be reinvested in programs and helping Canadians, businesses, and communities that are needing, whether it's climate change or aging profile and the need for healthcare. That's going to help there. And then third, we've committed, as you know, to 1% of our profit goes to our communities, and that increased profitability will be donated to our Canadian communities. So as you think about, John, how that all comes together, that's the definition of how productivity, increased productivity, or bringing two platforms into one platform benefits Canadians and helps Canadians grow, and we're committed to delivering that.
And as a global leader, you often have to think about what the economic landscape looks like, yep. At least for Canada right now. What's your assessment of what's happening with our economy?
Interest rates are working. right? Higher rates have led to repricing of business loans, have led to higher interest rates for mortgages, which has been difficult. That takes cash flow out of the economy, and therefore the economy is slowing from a demand perspective as rates are working. You're seeing that slow on the credit card side as well, and therefore inflation is coming down. So we have generally, it's a little slower than we would like, we're generally seeing inflation come down given the tightening that we're seeing on the monetary policy side. That's been offset a little bit by government deficits and by 1 million new Canadians coming in from abroad and immigrants coming. That has added a bit to the inflationary pressure. But still, we're on track for rate cuts, this summer and into the fall. And I think that relief will be welcomed by Canadians and will help bring down mortgage rates and bring down overall the more costs of servicing a mortgage for Canadians. So I think that relief will be necessary. But don't forget, even if rates come down by 100 basis points or 50 basis points, that's still tightening. Right, a 4% rate in the economy is still not an expansionary rate; it's a tightening rate, and therefore that still will have an effect on the economy going forward. So things are a little bit softer than I think some of the headline numbers, given that they're boosted by immigrants. But overall, we appear to be fully on a path to engineer a soft landing for the Canadian economy. U.S. economy, different issues. Enormous strength right now because Americans have a 30-year fixed mortgage and therefore aren't impacted by higher rates and therefore have significant disposable income because their salaries have gone up. Their servicing costs of their mortgages haven't gone up, and therefore they're free to spend. And they're super stimulating the U.S. economy, which is why we're seeing stickier inflation, which is why we're seeing the U.S. economy outperform Canada, outperform the world, outperform Europe. Government deficits are even larger in the U.S., and that's super stimulative as well. So I think it's starting to slow, a little bit more slow than Canada. Inflation's still above the target, but you're hearing the commentary even from Jay Powell yesterday that we're still in a range that we'll see rate cuts this year, hopefully in the United States. So different effects, different issues at play, both definitely on a path to engineer a soft landing. I would call Canada a little bit softer though.
A lot of people look to the jobs market to try to make determinations on where the economy goes. I did hear you recently make some comments that made me wonder if you're thinking differently about the economic cycle today, maybe versus the past, just in terms of where the unemployment rate might ultimately be at whatever cycle point we're at right now versus what you would have seen in the past. Is that fair?
Yeah, absolutely. I think interest rate cycles have changed, that we shouldn't expect a net neutral rate in the economy, which is when you've got a 2% inflation and the economy's at full potential to be in that low 2% range, which we thought for a decade. I think now most pundits and most economists would forecast that it could be as high as 3.5. So rates will come down, but they're not coming down to 1 or 2. So when you make your business plans, when you think about your family finances, you got to plan for a longer medium-term rate of in the 3 to 4% range, and that changes business plans, and that can change families' plans overall about what type of house they might buy and what type of leverage they might take on. So I think that's part of it. There's demographic changes obviously coming. While we're bringing a number of immigrants in, we have an older boomer population that is retiring, and therefore we're going to be short a lot of skills and short a lot of jobs. And you're going to see, I think, lower unemployment rates just manifest itself from the demographic charge and change. And then we have this big unknown of generative AI and the power of AI and technology change and how fast, how much. I think it's up in the air, honestly, John. It's an incredible technology. Maybe we'll talk about it later. But it certainly has the chance to disrupt our traditional white-collar workforce market. But it's going to create new jobs as well. We don't know the timing, the pace, the nature of that, but it will be disruptive over time.